Stop looking at the stock price of Nvidia for a second. Stop looking at the market cap of Microsoft or the quarterly earnings of OpenAI. You are looking at the wrong numbers. You are looking at the digital scorecard of a game that is played in the physical world. Everyone is talking about the software, the algorithms, the large language models that are going to change civilization, but almost nobody is asking the most basic question of physics and economics. What are these things made of? You have been sold a lie called the cloud. It's a brilliant marketing term. It sounds ethereal, weightless, infinite. It implies that your data, your AI assistants, and your digital life are floating in the sky, free from the constraints of the earth. But the cloud isn't a cloud. The cloud is a building. It is a warehouse the size of 20 football fields, packed floor to ceiling with racks of servers, humming with electricity, generating massive amounts of heat, and demanding physical resources to exist. And inside every single one of those servers, inside every GPU that trains ChatGPT, inside every connection that links the digital brain together, there is one metal that makes it all possible. It's not gold, it's not copper, it is silver. You cannot have the AI revolution without silver. It is physically impossible. And here is the dirty secret that Wall Street isn't factoring into their spreadsheets. We are running out of it. Let's look at the hardware. The engine of the AI boom is the GPU, the graphics processing unit. Specifically, chips like Nvidia's H100 and the upcoming Blackwell architecture. These aren't just computer chips, they are supercomputing engines. A single H100 chip is a masterpiece of engineering, containing 80 billion transistors. But how do you connect 80 billion transistors? How do you move electricity and data through that system at the speed of light without overheating? You use the most conductive element known to man, silver. Silver is the best conductor of electricity in the periodic table, better than copper, better than gold. In the world of high-performance computing, where microseconds matter, where latency is the enemy, and where efficiency is God, you don't use copper if you can avoid it. You use silver. Silver is used in the soldering materials, the pastes, and the interconnects within the semiconductor package itself. But it goes deeper. The printed circuit boards, PCBs, that host these chips are laced with silver. The switches that route the data traffic use silver contacts. The power supply units that feed these hungry beasts, electricity use silver to manage the load. When you look at a standard laptop or a smartphone, the amount of silver is small, maybe a few hundred milligrams. But AI servers are not laptops. They are dense, high voltage, high temperature environments. The silver loading in high performance computing hardware is significantly higher than in consumer electronics because the reliability standards are different. If your phone crashes, you restart it. If an AI training cluster crashes, you lose millions of dollars in compute time. Reliability requires silver. Silver oxide, unlike copper oxide, is still conductive. That means even if the contacts corrode slightly, the connection remains. In a data center that runs 24/7, 365 at temperatures that would cook an egg, that chemical property is the difference between a functional trillion-dollar industry and a paperweight. Now, do the math on the scale of this build-out. Mark Zuckerberg recently admitted that Meta is acquiring 350,000 H100 GPUs. That is just one company. Microsoft is buying more. Google is buying more. Amazon is buying more. Sovereign nations are buying them. We are talking about millions of high-performance chips being manufactured and deployed every single year. But it's not just the chips, it's the supporting infrastructure. You cannot just plug an H100 into a wall socket. These chips require specialized server racks. Those racks require specialized cabling. The cabling requires high-speed connectors. Every single interface in that chain represents a physical demand for silver. We are seeing a shift in the electronics industry. For years, manufacturers tried to thrift silver, meaning they tried to use less of it to save money. They switched to copper where they could. They made the plating thinner. But with AI, that trend is reversing. So the performance demands are so high that they cannot afford to be cheap. You don't put a $30,000 chip on a cheap circuit board with inferior connections. You build the best board possible. That means more silver per unit, right at the moment when the volume of units is exploding. This is a structural change in demand. We aren't talking about jewelry that sits in a drawer. We aren't talking about silverware. We are talking about industrial consumption, where the metal is essentially destroyed. When silver is used in a microscopic layer inside a multi-layered ceramic capacitor or semiconductor package, it is incredibly difficult to recover. It is effectively consumed. It is gone. The tech industry views silver as a shelf item. They think they can just order it like they order office chairs. They assume the supply is infinite. They assume that if they need more, the market will provide it. They are looking at the price of silver today and assuming that price reflects availability. But, as we discussed before, the price is a fiction set by paper traders. The tech giants are about to collide with the geological reality of the mining industry. You cannot download silver. You cannot code silver into existence. You have to dig it out of the ground. And the ground is getting stingy. We have mined the easy silver. We are now chasing lower and lower grades of ore. We are digging deeper holes for less reward. And now, suddenly, the most capital-intensive, resource-hungry industry in human history, artificial intelligence, has decided it needs massive quantities of this specific metal to survive. Think about the sheer volume of capital being deployed. We are hearing estimates of $1 trillion in AI infrastructure spending over the next 5 years. $1 trillion. If even a tiny fraction of that capital flows into the physical materials required to build the hardware, it will overwhelm the silver market. The silver market is tiny. It's a pimple on the face of the global economy. It cannot absorb billions of dollars of new demand without the price going vertical. The AI boom is essentially a giant short squeeze on physical silver waiting to happen. The tech CEOs know software. They know marketing. They know user acquisition. But very few of them know geology. Very few of them understand that the supply chain for their precious chips begins in a lead-zinc mine in Peru or Mexico that hasn't seen new investment in a decade. They are building skyscrapers on a foundation of sand. They are planning for exponential growth in computing power, which requires exponential growth in physical inputs, in a world where the physical supply of silver is flat or declining. This is the definition of a collision course. And here is the most dangerous part of this Part 1 analysis. The market hasn't priced this in yet, not even a little bit. If you look at analyst reports for silver demand, they often bucket electronics into a slow growth category. They are looking at declining smartphone sales and assuming electronics demand is flat. They are missing the pivot. They are missing the fact that an AI server uses multiples of the silver found in traditional computing. They are missing the fact that the entire electrical architecture of these data centers is being redesigned to handle higher loads, which brings us to the next problem, the energy grid itself. But as far as the chips go, the die is cast. The orders are placed, the fabs are running, the silver is being consumed at a rate we have never seen before in the high-tech sector. You have a situation where the most valuable companies on Earth, Apple, Microsoft, Nvidia, Google, have a critical dependency on a commodity that is currently priced at $30 or $60 an ounce. To them, the price of silver is irrelevant. If silver goes to $500 an ounce, does Nvidia stop making chips? No, the cost of the silver in the chip is negligible compared to the price of the chip. They will pay any price. This means the demand from the tech sector is price inelastic. They will not stop buying just because the price goes up. They will just bid higher. They will bid the price up until the jewelry makers are priced out. They will bid it up until the solar manufacturers are squeezed. They will bid it up until the retail investor can't afford a coin. The AI boom creates a buyer who has infinite pockets and a mandatory need for the metal. That is the perfect recipe for a super spike in price. And we haven't even talked about the buildings yet. We haven't talked about the power. That is where the numbers get truly frightening. It is not just the microchips. If you focus only on the silicon, you miss the forest for the trees. The AI revolution is not just a computing revolution, it is an energy revolution. And energy requires transmission. Transmission requires silver. Let's talk about the data centers themselves. These are not the server farms of 10 years ago where you hosted a website and checked your email. These are AI factories. That is the term industry insiders are using. An AI factory is designed to consume electricity at a scale that is hard to comprehend. A standard Google search uses about 0.3 watt-hours of electricity. A ChatGPT query uses roughly 2.9 watt-hours. That is nearly 10 times the energy consumption for a single interaction. Now multiply that by billions of queries a day. Multiply that by the training of the models, which takes months of running thousands of GPUs at 100% capacity. The International Energy Agency projects that data center electricity consumption could double by 2026. In the United States alone, data center power demand is projected to triple by 2030. We are talking about adding the equivalent of the entire electrical consumption of Japan to the grid, just for AI. Where does silver come into this? Everywhere. First, you have to get the power to the chips. You cannot run these massive currents through standard copper wiring without significant losses and heat generation. In the high voltage switchgear that protects these multi-billion-dollar facilities, silver is the standard material for contacts and breakers. Silver-plated copper bus bars are becoming the norm in high-efficiency power distribution units, PDUs, within the racks. When you are pushing 100 kilowatts per rack, which is where we are heading with the new Nvidia clusters, efficiency is everything. A 1% loss in efficiency due to electrical resistance translates to millions of dollars in lost power and massive amounts of waste heat. To minimize resistance, you maximize silver. Then there is the heat problem. Thermal management is the single biggest bottleneck in AI hardware. If the chips get too hot, they throttle. If they throttle, you lose money. Silver is not just the best electrical conductor, it is also the best thermal conductor of all metals. We are seeing a rise in the use of silver sintering pastes for attaching chips to heat spreaders. This technology replaces traditional soldering because silver sintering creates a bond that is pure metal with far superior thermal conductivity. As chips get hotter and denser, the industry is forced to use more silver to wick that heat away. But let's step outside the data center. How do we generate this electricity? The tech giants, Microsoft, Amazon, Google, have all committed to net zero carbon goals. They cannot power these AI factories with coal. They are demanding green energy. They are signing massive power purchase agreements, PPAs, for solar and wind. This connects the AI boom directly to the solar boom. We already know that solar panels are the voracious beast eating the world's silver supply. Photovoltaic cells use silver paste to collect the electrons generated by sunlight. The solar industry alone is consuming over 200 million ounces of silver a year, nearly 20% of the entire global supply. Now, because of AI, we need to accelerate the solar build-out. We need more gigawatts of power to feed the AI factories. That means we need more solar panels. That means we need more silver. It is a compounding loop. AI demands power. Green power demands solar. Solar demands silver. And let's talk about the grid itself. The US electrical grid is old. It is crumbling. It was not built to handle the load of thousands of new hyperscale data centers. It requires a massive overhaul. We are talking about smart grid technology, high voltage transmission, and massive amounts of switching equipment. Every smart switch, every high voltage breaker, every reliable contact point in the grid uses silver. Why? Because silver doesn't spark as easily as other metals, and silver oxide doesn't cause the connection to fail. In critical infrastructure, you pay for silver because the cost of failure is blackouts. There's a concept in economics called the Jevons paradox. It states that as technology increases the efficiency with which a resource is used, the total consumption of that resource increases rather than decreases. People will tell you, oh, they will figure out how to use less silver per solar panel, or they will make the chips more efficient. That is the Jevons paradox trap. Yes, they might use less silver per unit, but because the unit becomes cheaper and more efficient, they will build 10 times as many units. If AI makes coding and engineering 50% more efficient, we won't do the same amount of work in half the time. We will do 10 times the amount of work. We will build more data centers. We will deploy more robots. We will install more sensors. Speaking of robots and sensors, this is the next wave of AI. AI isn't just going to stay in the chatbot. It is going to move into the physical world. Tesla's Optimus robot, Figure AI, Boston Dynamics, they are building humanoid robots powered by AI brains. What is a robot? It is a collection of motors, sensors, and actuators. Every motor needs connections. Every sensor needs sensitive electronics. Every actuator needs reliable power delivery. The silver content in a humanoid robot is going to be significantly higher than in a smartphone. If the plan is to build millions or billions of these robots to replace human labor, where is the silver coming from? The Internet of Things, IoT, is another silver sinkhole. AI needs data. To get data, you need sensors everywhere. Smart cities, smart homes, autonomous vehicles. 5G towers to transmit the data. 5G technology is silver intensive. The high frequencies used in 5G require silver-plated components to maintain signal integrity. The base stations, the antennas, the filters, they all demand silver. As AI demands faster data transfer, the 5G rollout must accelerate. So look at the convergence. You have the GPUs themselves, silver. You have the server racks and connectors, silver. You have the power distribution units, silver. You have the thermal management systems, silver. You have the solar panels generating the green energy, massive silver. You have the grid upgrades to move that energy, silver. You have the 5G networks to move the data, silver. And you have the future robotics sector, silver. Every single vector of the AI revolution points to higher silver consumption. There is no path to the AI future that does not go through the silver market. And yet, the price of silver is still treating it like it's just a monetary metal or a jewelry ingredient. The market is pricing silver as if demand is linear, but AI growth is exponential. Humans are very bad at understanding exponential functions. We think if demand was X last year, it will be X plus 1% next year. Exponential growth means it is X, then 2X, then 4X, then 8X. When the demand curve goes exponential and hits a supply curve that is flat, you don't get a gradual price increase. You get a vertical line. You get a market failure. You get a situation where you literally cannot buy the material at the quoted price. The energy monster that is AI is waking up. It is hungry, and its diet consists of electricity and the metals that conduct it. The tech companies have trillions of dollars to buy the food for this monster. They will pay whatever it takes. But the mining companies haven't been planting the crops. They haven't been opening the mines. We are walking into a resource squeeze that will make the 1970s oil crisis look like a minor inconvenience. Because you can pump more oil, you can find more oil, but you cannot simulate a silver mine. You cannot print an element. Now that we understand the demand side, the insatiable hunger of the AI beast, we have to look at the supply side. If demand is going vertical, surely the free market will respond. Surely if the price ticks up, miners will just dig up more silver. This is the biggest misconception in the financial world. People think commodity production works like a factory. If you need more shoes, you hire more workers, buy more leather, and run the machines longer. Mining does not work like that. First, you have to find the deposit, then you have to prove it exists, then you have to get permits, then you have to build the infrastructure. The average time from discovery to first pour of metal is now over 15 years. If we started a massive crash program to find new silver mines today, that metal wouldn't hit the market until the 2040s. The AI boom is happening now. But it's worse than that. As I mentioned in the previous video, most silver is not mined on its own. Roughly 72% of the world's silver comes as a byproduct of lead, zinc, copper, and gold mines. This is a critical concept to understand. The supply of silver is inelastic to the price of silver. If the price of silver goes to $100 tomorrow, a copper mine in Chile is not going to double its production. They are mining for copper. The silver is just a bonus credit that offsets their costs. They cannot just turn a dial and produce more silver without flooding the market with copper, which would crash the copper price and bankrupt the mine. So, silver supply is held hostage by the demand for other base metals. And base metal mining is facing its own crisis. Ore grades are collapsing. We have mined the high-grade stuff. Now we are processing literally tons of rock to get a few grams of metal. This requires massive amounts of energy, diesel and electricity, which makes mining more expensive. Let's look at the primary silver mines, the few mines that actually focus on silver. They are struggling. The big ones in Mexico and Peru are dealing with labor strikes, water shortages, and declining grades. Political instability in these regions is rising. Governments are talking about nationalizing resources or raising taxes. This discourages investment, so supply is capped. It's stuck. It might even decline. Yeah, but wait, the skeptics say. What about recycling? There is so much silver in old electronics. We will just recycle our way out of the shortage. This is the recycling myth. It sounds good on paper. It fits the green narrative. But the physics and economics of it are broken. Yes, there is silver in your old iPhone. There is silver in your discarded laptop. But how much? We are talking about milligrams. It is dispersed in tiny quantities, glued to plastic, soldered to fiberglass, mixed with toxic chemicals. To recover that silver, you have to collect millions of devices, ship them to a smelter, shred them, melt them down, and chemically refine them. This process is energy intensive and expensive. It is only profitable if the concentration of metal is high enough. But remember, thrifting? For the last decade, manufacturers have been making the silver layers thinner and thinner to save money. This means the e-waste created today has less silver in it than the e-waste from 2010. It is becoming less profitable to recycle. Furthermore, consumer behavior is a hurdle. People don't recycle their electronics efficiently. They throw them in drawers. They toss them in landfills. The collection rate for global e-waste is roughly 17%. That means 83% of that silver is being buried in the ground, effectively returned to the earth, but in a form that is impossible to mine. Industrial recycling is better, but it's not 100%. And here's the kicker. AI applications require high purity silver. We are talking about 4N, 99.99%, or even 5N, 99.999% purity. You cannot just melt down an old spoon and put it into an Nvidia chip. It requires sophisticated refining. The refining capacity of the world is limited. Even if we had a mountain of scrap silver, there is a bottleneck at the refineries. Building new refineries takes years and faces massive environmental opposition. Nobody wants a chemical refinery in their backyard. So we have a supply side that is geologically constrained, politically vulnerable, and economically inelastic. And we have a recycling sector that cannot scale fast enough to meet the new demand. Let's look at the deficits again. The Silver Institute reported a 184 million ounce deficit in 2024. That was before the full scale of the AI infrastructure build-out was factored in. That deficit was driven by solar and conventional industrial use. When you add the aggressive projections for AI hardware, data center build-outs, and the associated energy grid upgrades, that deficit could easily swell to 250 or 300 million ounces a year. That is 25% to 30% of the entire global market. Where does that metal come from? In the short term, it comes from above-ground stockpiles. It comes from the vaults in London and New York. It comes from selling down the inventory of ETFs. But those stockpiles are finite. We have been drawing them down for 4 years straight. The visible inventories are dropping. The inventories on the Shanghai Gold Exchange have plummeted. The inventories on the COMEX are near multi-year lows. We are burning the furniture to heat the house. Eventually, you run out of furniture. When the vaults run dry, there's no backstop. There's no strategic petroleum reserve for silver. The US government sold off its strategic silver stockpile decades ago. They have zero, nothing. This leaves the industrial users naked. If you are Apple or Samsung or Tesla, and you rely on a steady flow of silver to keep your factories running, you are looking at these charts and you are starting to panic. You realize that just-in-time inventory management is a suicide pact in a structural deficit. So what do smart companies do? They start hoarding. They move from just-in-time to just-in-case. They start buying physical metal to secure their supply chain. But here's the problem. If a few major tech companies decide to buy a strategic stockpile, let's say Apple decides to buy 50 million ounces to secure 5 years of production, that news alone would break the market. 50 million ounces is a massive chunk of the available float. The price would skyrocket. So they have to do it quietly. They have to do it through intermediaries. They have to do it off-market. This is why the price on the screen often doesn't make sense. The real battles for physical metal are happening in the dark, in private bilateral deals between refiners and industrial giants. The paper price on the COMEX is becoming a sideshow. It's a casino for hedge funds. The real market is the physical scramble for 1,000-ounce bars. And in that market, the miners hold the cards, but they don't know it yet. Or maybe they do. We are seeing consolidation in the mining industry. Big companies buying small companies. They are trying to secure reserves in the ground because they know what is coming. They know that an ounce of silver in the ground is worth far more than the current paper price suggests. The disconnect between the digital narrative of infinite AI growth and the physical reality of finite silver resources is the single biggest arbitrage opportunity in financial markets today. You have a sector, tech, valued in the tens of trillions, dependent on a sector, silver, valued in the billions. It is like trying to push an elephant through a straw. Something has to give, and what will give is the price. The price has to rise high enough to destroy demand elsewhere. It has to rise high enough to make someone stop buying. But who stops buying? The solar industry? They are mandated by governments. The AI industry? They have infinite cash. The military? They need it for missiles. The only person who stops buying is the investor. The price will rise until you, the retail buyer, sell your stack back to the industry. That is the end game. They need your silver. And they will have to pay a fortune to get it. We have established the mechanism of the crisis. We have the unstoppable force of AI demand meeting the immovable object of geological scarcity. Now we need to talk about what happens when they collide. We need to talk about the future of money, technology, in your portfolio. This is not just a trade. This is a paradigm shift. We are moving from an era of financial abundance and physical abundance to an era of financial abundance, printing money, and physical scarcity. In this new era, the entities that control the physical inputs win. The entities that only hold paper promises lose. Think about the implications for the tech giants. Companies like Nvidia and Microsoft are currently priced for perfection. Their stock prices assume uninterrupted growth for a decade. But what if the supply chain snaps? What if they literally cannot build the data centers fast enough because they cannot source the high voltage equipment? What if chip yields drop because refining quality suffers due to a scramble for scrap metal? We are already seeing lead times for high voltage transformers stretching to 3 or 4 years. That is a supply chain failure. Silver is next. When silver goes into shortage, we will see allocation. Allocation is a polite word for rationing. It means the refinery calls up the client and says, I know you ordered 10,000 ounces, but I can only give you 5,000. When allocation hits the silver market, panic sets in. Panic buying is distinct from normal buying. Panic buying is price agnostic. It is fear-driven. We saw a glimpse of this in 2020 and 2021 with the silver squeeze movement, but that was retail investors. Imagine a silver squeeze driven by Samsung, LG, and TSMC. Imagine industrial giants panicking. That is how you get a price explosion. That is how you get silver moving $5 or $10 a day. And we must consider the national security angle. AI is not just about writing emails or generating funny images. AI is the new arms race. It is about cyber warfare, autonomous drones, missile defense systems, and economic dominance. The country with the best AI wins the 21st century. The US government knows this. China knows this. Why do you think China has been importing massive amounts of gold and silver? They are cornering the commodities market. They control the refining capacity for many critical minerals. If silver becomes a bottleneck for AI development, it becomes a national security issue. We discussed the critical mineral designation in the previous script. This is where it gets real. If the US Department of Defense decides that silver is vital for the AI-driven military of the future, they could nationalize domestic production. They could ban exports. They could force mines to sell only to US tech firms. This would balkanize the silver market. You would have a US price, a Chinese price, a European price. The global spot price would become meaningless. So what does this mean for you? It means that the silver in your hand is potentially unobtainium. It means that the opportunity to exchange fiat currency, which is being printed into oblivion to fund these deficits, for a finite industrial element is closing. The window is still open right now. You can still go online and buy silver. The premiums are high, yes, but you can get it. But as the AI narrative matures, as Wall Street wakes up to the dirty secret we have discussed, the capital flows will shift. Right now, trillions of dollars are chasing AI stocks. Eventually, some of that money will look at the supply chain risks and start buying the commodities backing the tech. Even if 0.1% of tech capital rotates into silver, the price doubles. The market is that small. The argument against silver has always been, it's just a rock. It doesn't pay a dividend. It doesn't do anything. That argument is dead. Silver does everything. It computes, it transmits, it connects, it powers. It is the blood in the veins of the digital organism. You cannot be bullish on the future of technology and bearish on silver. It is a contradiction. If you believe in AI, you must believe in silver. If you believe in green energy, you must believe in silver. If you believe in the electrification of the world, you must believe in silver. But here's the irony. The price of silver today is priced for a recession. It is priced as if nobody needs it. That is the asymmetry. That is the dirty secret. The market is mispricing the most critical metal of the digital age. So how does this end? It ends with a repricing event, a reset. The paper shorts on the COMEX will eventually be overrun by physical demand. The industrial users will break the mechanism of price suppression because they cannot eat paper contracts. They need the metal. We will likely see silver decouple from gold. Historically, they move together, but gold is money. Silver is money plus strategic technology. In an industrial squeeze, silver should outperform gold significantly. The gold to silver ratio, currently in the high 80s, could collapse back to 30 or 20 or even 15. That means silver could go up 4x or 5x relative to gold. But forget the ratios. Think about the utility. In 2030, when you're talking to your AI assistant and your house is powered by solar and your autonomous car is driving you to work, look around. Everything making that life possible depends on silver. We are building a future that requires more silver than exists in the ground. We are building a digital Tower of Babel on a foundation of finite metal. The AI boom is real. The demand is real. The shortage is real. The only thing that isn't real is the price on your screen. And that is about to change. Do not wait for the CNBC headline. Do not wait for the Bloomberg terminal to flash red. By the time they're talking about the silver crisis, the metal will be gone. The smart money is already moving. The insiders are already hoarding. The tech giants are quietly securing their lines. You have the information now. You know the secret. The question is, what are you going to do with it? Are you going to hold the paper dollars that are losing value? Or are you going to hold the physical key to the future economy?